So far, October has been a very mixed month for the S&P 500, but if we take a look at the semiconductor space, whilst Nvidia is down around 2.5%, under the spotlight today, Micron Tech is up 24%, putting it in the second best semiconductor in October, behind AMD, which is up 45%. And if we go one step further and look at year-to-date 2025, many companies are flashing green, but one of the best, not only in the semiconductor space, but across the market, is Micron Tech, and that is up 146%. Not only that, in the pre-market, it is also up around 3%. It is climbing higher, and for a company that's up year-to-date in the triple digit, over the last year up nearly 100%, and over the last 10 years up more than 1,000%. The question is, as of today, is Micron Tech one we should add? Will we see more explosive growth? Maybe we've made quite a lot of money and we're considering trimming or selling, or in fact, this is one that we should just keep holding. It's also trading pretty much around a 52-week and all-time high. We may see it smash through that later today. Quant with a very rare strong buy, 4.99 out of 5. Wall Street themselves, 4.43, very near to the 4.5 to flip this into a strong buy, with equally a buy rating from Seeking Alpha. So let's dive in, understand a bit more about Micron Tech. And the first thing we will point out on a forward P, just in isolation, 12.5 does look very low for the growth we're about to explain this company is projecting, although it is slightly above their 5-year average of 11.6. And when we do look at the blue tunnel, which for newer viewers highlights the intrinsic or fair value, it is sitting right at the upper end, so we would call this a reasonable valuation, potentially maybe a little bit overvalued. But what's great to see is that over the last year, the blue tunnel has been increasing in the right trajectory, and in terms of the grading overall, it does get a B. Now it's trading in fact at a 51% discount to the sector overall. Against their own 5-year average, it's trading at an 84% discount based on the Seeking Alpha data. And if we look at the price to earnings growth, well, 0.2, making it probably one of the best companies to consider even after the run-up. That is an extremely rare figure to see when the sector overall sits much higher at 1.8, so a 90% discount. You can probably also see, which we will cover some of these later today, that on valuation, a B, growth A+, profitability A+, momentum as well as revisions, all giving the highest score obtainable. Maybe something you wouldn't expect for a company that has had such an incredible run so far. And just giving a bit more background about the company, we can see overall the semiconductor value chain and where Micron Tech fits in, but they're one of the world's leading semiconductor manufacturers, and they specialize in memory chips, specifically DRAM and NAND, which are essential for everything from smartphones, laptops, to AI data centers, and they operate as a fab, meaning they actually fabricate and produce the chips themselves rather than just designing them, and their ability to scale memory production efficiently makes them a key player in the AI and data storage boom. We can also see from their latest earnings, which they reported at the end of last month, they were struggling to meet the demand. That is a fairly positive thing to note. And if we do look at their earnings, as we said, the end of September, they had a double beat where earnings per share was up 157%, triple digits from the same quarter last year. Not only nice growth on the revenue, but even on a quarter-by-quarter basis, Micron Tech is up double digit, both EPS as well as revenue, where when we take a look, top line was up 46% year on year. The vast bulk not only making up nearly half of their top line, but look at their growth in the cloud memory, the one also with the strongest operating margin at 48%. It was up 214%, and as we just said, they're struggling to keep up with all of this demand. And the other thing not many people talk about is efficiencies. Their gross profit was up 9 percentage points year on year, operating up double digit, bottom line as well, up 17 percentage points. So not only are they increasing their top line at a strong double digit rate, but we're also seeing some huge improvements to their efficiencies, so far looking very strong. And not only that, over the next 4 quarters, as they have fully reported for 2025, in 2026, they're expecting 3 of them for EPS to grow at a triple digit rate, even Q4 closing out at 53%. Now you may think, how can we really trust management? They are going to be able to execute on this. Well, no one knows the answer, but it does give us faith that over the last 4 quarters, they have outperformed on each one, giving it a 100% track record. And ultimately, if they do hit the EPS of $19 or thereabouts for the next full accounting period, their forward P does drop to around the 11 region. Now, just a few snippets from their latest investor presentation where they said they have an outstanding finish to the end of 2025, something we just in fact saw in that latest quarter, and they said they delivered their Q4 not just revenue but also gross margin and EPS all above even the higher end of their guidance range, meaning if they do something similar for 2026, this company could potentially extend this explosive growth that we've seen, and they believe that entering into 2026, this company is better positioned than ever, and that's all down to the AI-driven demand, the need for this memory, which we just saw triple-digit increase in Q4, and their guidance for Q1 2026, well, we're talking record numbers for Micron on revenue and earnings per share. And I thought this was quite interesting where they do talk about artificial intelligence. They're saying they've got strong adoption where in fact around 30 to 40% productivity uplift, and that in itself is one of the reasons why we have seen such strong efficiencies right across every single margin line. And as we said, revenue was not only up double digit year on year, but double digit from the previous quarter. That is absolutely phenomenal to see. Revenue for the full year, in fact, 37.4 billion reported. That is very, very impressive. Incredibly rare to see companies produce such results. Maybe the likes of Nvidia and just a handful of other names. And whilst we haven't touched upon it, this company does in fact pay dividends over the last few years, paid out around 2 billion, as well as returning excess cash through share buybacks, something maybe we will see the continuation of. They used around 3.2 billion in the same period, meaning they prefer to buy back shares rather than pay dividends. And we can note the free cash flow for the full year, something we will incorporate when we take a look at our discounted cash flow model. And one of the things we really wanted to point out, again, that will be the basis of our DCF, but they said they expect their free cash flow to strengthen into Q1, and they project significantly higher annual free cash flow into 2026. So that is looking promising. You will be able to see how this reflects when we get to the valuation stage. And analysts are also getting very bullish, even though it's been on an incredible run, as we said, up nearly 150%. UBS just a few weeks ago raising their target to $245. We can see Deutsche Bank from last month raising it to $200. So perhaps when they take a look at this again, we will see another increase around the same levels of UBS. And just look at their growth where they get an A+. Last year it was up 49%. They're projecting around 34 into 2026, well above the sector median, also a huge improvement to their 5-year average. So we can see the demand for AI is really helping them rapidly increase their top line, and earnings per share is no different. 66% growth projected over the next 3 to 5 years, well above the sector at 16, well above their historical at 10.3, and likewise profitability coming at an A+. 40% on the gross margin. Yes, it is below the sector at 50, but look at that, huge improvements to their 5-year average of 27%. Bottom line, 23%, not only well above the sector at 5, but huge improvements again to their 5-year at 8. We love to see this, and this is all encapsulated when we review the cash from operations. 18 billion on a trailing 12 month, a massive, massive increase from their 5-year at 10 billion. So looking good, firing on all cylinders so far from Micron Tech. And if we look at the institutions with their 81% ownership, they did sell 11 billion in the last year, where in fact they bought around 70% more at 18 billion. But in the most recent quarter, we do get a little bit of indifference in terms of buying and selling. If you wanted to see the last time where they sold more, well, Q3 2024. Otherwise, more often than not, institutions are in fact heavy net buyers of MU overall. And the other thing we like to do is compare their performance against others in the sector. We have Qualcomm, Intel, ARM, TXN, Analog Devices. And look, over the last year, they are up around 98%, making them the best performer in this industry. If we extend over the last 5 years, they're up 301%, again, the best performer. And that narrative still holds when we zoom out to the last 10, up 1,180%. So yes, incredible performance over the last 10 years. The question you need to ask yourself as an investor is, Can they sustain this over the next 5, 10, 15, whatever your time horizon is, as ultimately past performance is not an indicator of the future. And we'll also just highlight that when we compare it to the S&P and the QQQ, again, huge outperformance in just the last 12 months. Conclusion the same when we do zoom out to the last 5 years. And again, no surprises, over the last 10, this one has massively outperformed. So let us know your views in terms of where you see this over the next 10 years. And one thing we haven't touched upon, yes, it is in the semiconductor space, which does mean in fact it is in a cyclical industry, but over the last 10 years, they have increased their revenue from around 12 billion in 2016 to now at 38, so just over 3 times. But what we want to understand is, what does the bottom line net income tell us? Do we get that consistency, or is the story a little bit different? And the answer may surprise you, we don't actually get continued growth to the bottom line net income. It was a loss reported 10 years ago of 276 million. Now, yes, nice 8.5 billion net income, but just look at the previous year and some of the years before. There is a lot of inconsistency, something to factor in when we do think about this company and perhaps a margin of safety in the valuation stage. With the other thing being a quick health check, total cash versus total debt. They had 4.4 billion of cash 10 years ago, now sitting on just over 10 billion, but as always, one number here, pure isolation, won't give anything away. So when we do compare that to their total debt, we can actually see quite inconsistent. 10 billion 10 years ago today, now sitting at 15. Not massive disparity between cash and total debt, but we will take a look at the net debt to EBITDA to give us a better reflection, and probably worth having a look at some of the underlying metrics. But what this really highlights is the cyclicality. There is no consistent growth to the free cash flow per share. The same to be said in terms of sales, and we highlighted that too. Although last 2 years we have seen strong double-digit growth. Shares outstanding, some years they do share buybacks, not as consistently as we would like. Maybe something management will be putting on pause if they believe the share price is getting a little bit ahead of itself. ROIC, again, inconsistency where we want to see a minimum of 12% for the industry to give us faith management are able to effectively allocate their capital. We're not getting a sign of that. Although look, most recent year it was at 11%. Margins, well, inconsistency straight throughout, both on the operating side and the free cash flow. But finally, the net debt to EBITDA that we mentioned does look strong. Below 1.5 is what we want. 0.28 on a trailing 12 month, expected to go lower over the next year. So it does look like, at a high glance, and from what we just ran through, the balance sheet does look to be secure, but something always to keep an eye on. And worth highlighting, a few months ago, they were putting down a marker to say that they're going to invest $200 billion into manufacturing in the US, so that is a good sign. Demand does still look to be there, and perhaps we will see continuation of strong growth. Now, before we jump into our valuation, we want to let you know we have released our latest free weekly article. We do on every single Sunday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, our intrinsic price got to $212 after the release of their latest earnings, as you can see, solely based on the DCF model, where we have a growth rate of 20% moving forwards. Interestingly, on a reverse DCF, that highlights baked in today is 20% growth moving forwards to the future free cash flow, telling you as an investor at a high level, if you believe that is too high, perhaps you see this as overvalued, too low, undervaluation. Remember, we do have 3 targets, 15, 20, 25, low, medium, and high. But as always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for MU or any others. But based on the growth rate of 20% and the discount rate, we get the present value of future free cash flows and terminal price. Add together with the cash, subtract total debt, gives us the equity value divided by the shares outstanding, getting us to 212, indicating no upside, but also no downside. For those that believe that is way too high, and for transparency, At 15%, 149, downside of 30. At 25%, 299, upside of 41. Now remember, management did say they are anticipating a very strong growth year for the future free cash flow, and as we typically like to use the middle rate at 20%, we will just flag there is no margin of safety, in fact 0.1%. As always, we like to use 10% at a bare minimum to execute buy if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. That means a buy at $191, at 20% a buy at $170, and at 25, $159. Now Wall Street on average have a price target of $240 into next year. That is 13% upside, but let us know your views on MU today. Is it a buy, hold, or perhaps avoid? For those that believe we are using 2 conservative numbers at 25% of 229 intrinsic value, this turns to a 29% margin of safety. So maybe one to consider, but it does ultimately come down to whether or not you believe this company can continue the strong growth it has recently seen, or in fact cyclicality will come back around and we'll see this one start to slow down. So give us your views on MU overall, and don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.